Hello, I'm Robert and welcome to my channel, where I discuss everything automated algorithmic trading, or simply algo trading. This is a live look of today's market and the past couple of weeks. It's been a very interesting market and one that has been quite profitable. But we're not necessarily going to spend a lot of time talking about the market directly. More specifically, I want to focus on the big issue of the trades, and specifically how to handle large numbers of trades. In this case, as you can see from the right hand side, I have roughly 100 trades on the screen. Now I'm going to try a new tool and see how well things work. Basically, we are talking about this section right here. All of the trades. And those trades can be done in several different techniques. That is, I can examine each order one by one to determine if it's in profit or loss, which is the classical technique. It's what computer programs have used, well, since the dawn of computer programs, to go through each trade one by one and verify the state of that trade. But in the continued work of my research with artificial intelligence and trying to build trading in a way that is aligned with the way the human brain thinks, I wanted to take time to actually look at the problem differently. Because scanning all of these orders takes roughly 2 to 3 minutes of time. And if you know anything about the market, you know how quickly it will change in 2 to 3 minutes. So I needed a way to look at the market and get the best and most likely situation of what would be able to identify the quickest way of looking at all of these trades. So through that process, I started testing and using my AI model analysis to optimize how the program actually looked at the trades. So from that standpoint, the human brain will look at this, and there's only two areas that really matter. The part that is in profit and the part that is likely to be in loss. That's it. So basically we can look at the first order and the last order, the highest priced order and the lowest priced order. So subsequently, by using those two values, we can evaluate the entire list of trades for profit and loss in anywhere from 20 milliseconds to roughly 1 second, depending upon broker lag. So from the standpoint of the market, rather than taking 2 to 3 minutes to scan these trades, we can make a reasonable evaluation in basically 1 second. And that causes the entire process to become more efficient. This is especially important if you trade more than one pair. Say I trade 5 pairs. At 2 minutes per scan, it means my total scan time of all of my trades is going to take roughly 10 minutes. Whereas if I can do all 5 pairs in 5 seconds, I have gained a significant advantage over traditional thinking. And that really is what algorithmic trading benefits the most. By looking at the problem in a different context and through proper use of AI and optimizing the trading practices that emulate the way our human brains think, we gain a better perspective of how to manage our trades and our risks more efficiently. So from the standpoint of the first trade and the last trade, let me zoom in here. As we can see from the first trade, right here, this very first trade is what we need to consider for a take profit. So without even looking at any of the other orders, because the ticker is above the first trade, we can completely skip the whole process. In essence, we have just taken 20 milliseconds to make an entire decision process regarding all of our trades. Nothing is in profit. It's a very quick and simple process. By doing that, we actually gain a quick advantage that now we can look at our stop loss or our lowest position, the entry that is most likely to be at a loss, which will of course be way down here. Right here. This one is most likely to be at a loss. So we've eliminated the take profit. Now we can examine the loss. And if it doesn't meet the criteria of the loss, then we're done. From the standpoint of the analysis, by looking at the first trade only and the last trade only, all of this in here simply gets eliminated because we already know through deduction and logic that if the first or highest priced trade is not in profit and the lowest priced trade is not crossed the stop loss level, then none of the middle trades will be affected either. So we have made a clear consensus through a very careful algorithmic process that was refined by an AI approach to study how the human brain processes large quantities of information. So from that standpoint, we now have a realistic framework to build upon and begin testing. We are now looking at Oliver Twist, and we can see where I am scanning multiple trades, precisely 232 of them, with an average time of roughly around 3 minutes. Now this is using the traditional one-by-one order to verify that each order is in fact either within take profit or stop loss. But as we looked at the previous aforementioned approach, by looking at only the high and the low, we can drastically fix this real-world issue. I'm actually running the scan now exactly as it would be done in real time using traditional methods. This is where I am testing the proof of concept with respect to what will take per a single trade. And as you can see here, we are looking at roughly 0.01 to 0.02 seconds. Basically, 10 milliseconds to 20 milliseconds per trade. Now this is optimized extensively so that only trades that have price information embedded in them are being evaluated, so that our API call is only one specific call to catch the ticker data as it's updated. Now we can optimize that a little more by only collecting the ticker at the beginning, but we run the risk of having problems if we have a trade that is in profit or loss and then the 10 to 20 seconds required to process that single trade. There are, of course, other optimizations that you can do, such as updating the ticker after the fact. So this is a case that can be optimized in multiple ways, but the overall duration of the process is still going to be 2 to 3 minutes looking through every single trade on a broker that is very efficient. If you have a broker that is not as efficient or ends up in a heavy situation of volatility and a high API performance, then you are going to see significantly larger issues that could take a lot longer for trade information to be processed. So by having so many API calls, even if it is only collecting the ticker data, hurts the process altogether. Because as we continue to scan this list one by one in a linear fashion, the first trade could still go into profit. But we will never know that at this stage of the scan. That will have to be detected within the next continuous scan. So we significantly lose the advantage of rapid processing through a linear scan or through a traditional or conventional way of computer programming analysis. And even though we are processing quicker, we can see that a full sweep for this case took 3 minutes and a whole bunch of milliseconds. But then right afterwards, the high-low scan took place. That is looking at the first process or the first trade and the last trade for the same number of open trades. It only took 0.19 seconds, so roughly 19 milliseconds, to make the same determination that the full sweep system took in 3 minutes. This is very important, and it is a critical representation of just exactly what we are looking at, because we can identify problems very quickly. For example, ticket number 88610 has no price data. This is the same for both of these scans. And of course, there are ways of getting around that. The full scan and the advanced high-low scan could easily go out and get the information at a cost of 3 to 5 seconds. But for a process that takes 3 minutes, having another 5 seconds added to it becomes problematic, especially if you have more than one ticket number that does not have price data associated with it. If you have 10 tickets without price data, then you have the reflection of an additional 50 seconds to scan. So it becomes 3 minutes and 50 seconds. Now, unfortunately, collecting that kind of data is going to affect both types of strategies. So even the high-low process is going to be affected by the API calls. So instead of 0.19 seconds, it will in fact be 50 seconds as limited by the API calls themselves. But 50 seconds is still faster than 3 minutes and 50 seconds. So there is still a direct and deliberate advantage to processing trades the same way the human mind looks at the market. And that is really the encompassment of what AI is meant to be used for in trading. Using AI isn't about price prediction. It's not about magically making the world a better place or trying to magically figure out where prices are going. It's about isolating the market in a way that lets us carefully see where we actually need to look and how we actually need to function. By focusing on the two areas, that are most important at that particular moment, we can significantly improve our availability of information and our efficiency of processing that information in a meaningful way. The underlying benefit is better risk analysis, better formulation of high volatile markets, better control of our assets. So through understanding human emotion, through understanding human thinking, when we look at this chart in a computerized way, we become better traders overall. And we gain a way of using algorithmic trading in such a way that it can produce better results, which actually gives us the edge we need in staying profitable. I've talked about the issues of using Bollinger Bands, MACD, moving averages, and any other indicator under the sun multiple times, to the point that there is no edge of the indicator itself. There are hundreds of millions of people using the very same indicators day in and day out. So there is no magic indicator. That doesn't exist. That is an absolute and direct lie and deception. The indicators are not novel. They're not magical. They're only tools to help you identify certain situations. Your edge is in how you interpret, perceive, and manage the data and the risk. Your edge is how you look at price action and how you decide whether or not your market is going to function in such a way that you gain the advantage of that market. And that really is the whole point that we need to look at. The top and the bottom, the first and the last, the closest to take profit, the closest to stop loss. By functioning with just those parameters, we gain a level of efficiency in algorithmic trading that allows us a significant and deeper understanding of a nuanced condition, much like the human brain. Now let's take a few minutes to actually look at the code that you could see and develop for this kind of analysis. From the standpoint of both techniques, you need to read the orders into a list. The orders are simply stored on disk in a text file, from where I collected the information from actually opening the trades. Now we are using Jackrabbit Relay, of course, which is an open source project, free to use. Support does help me cover the expenses of continued development, and it is appreciated should you sponsor the project. So we will start by simply going through and initiating relay and picking up the exchange, the account, and the asset off of the command line. Then we will get the open orders out of the text file. And here's where the magic starts. The first process, the full sweep. It's not that complicated. It's just literally a loop that starts at the first order and goes through every single order. We capture any data that does not have a price and we simply disregard it. Again, here you could add a process to go out and collect the data, but for the purposes of this test, I wanted to keep this code simple. The only API code, or the only API that's actually made, is getting the ticker data. That's it. I wanted to keep this analysis as streamlined as possible. Even when I make the analysis of take profit, I did so deliberately in a way that I hard-coded my profit level of 10 pips. Now, the program itself will need to make this dynamic, but for the purposes of this test, I wanted to eliminate as many variables as possible. And again, we look at not in profit, or we look at whether or not it is in profit, and then we simply print by how much. A simple process, really, and somewhat pointless, because everything hinges right here. Getting the ticker and testing for profitability. 2 lines of code within the loop. From here, we will decide to just continue or to actually process the order and sell it. Now, there are multiple ways of handling that processing such that we can mitigate how much time this main loop takes. But that is a different context than what I'm looking at here. For the purposes of this concept, we are only going to focus on the main loop. And then I print how much time that main loop took. A simple equation, which comes out to roughly 3 minutes. Now let's look at the high-low process. We start off with some tricks that will set the highest price and the lowest price to infinity on both sides. This is a nice little mathematical trick that gives us a way of not having guessing games. And now, rather than processing the ticker every time, this time we're still using a loop. We still have to walk every single order. We're still identifying any order that does not have price data connected to it. But instead of processing the ticker each and every time, we focus on analyzing the highest and lowest prices. That is, we specifically look at the highest price in the list and the lowest price in the list. From the standpoint of the program, this process significantly reduces the speed implications of having multiple AI calls for every single order, multiple API calls, because we're not making any API calls here. So the standpoint of this process is that the order itself is going to be processed very quickly and distilled down to the highest and lowest positions within our list. Once we have that information, then and only then do we make our API call. So we're only calling the ticker information one time versus a full sweep of 200 times. So we have a clear and concise savings just in the API transition. But we also have a clear and concise savings in that we are only testing our data set once versus multiple times of each and every order. Now, truthfully be told, testing the data set for profit really is insignificant compared to the price collection for the ticker, the time required for the ticker. That is, getting the ticker data and the rate limits associated with your broker are going to be far more difficult to deal with than simply walking your list. So you want to mitigate your API calls as much as possible and limit them only to when you need to make them to save as much time as you can. Because even though you can optimize your code, as I did in this example, you cannot get around the rate limits of your broker. And that is how this system is actually able to achieve a 20 millisecond time rate versus a 3-minute time rate. So as you look at your code and you emphasize optimizations throughout the code over and over, timing it is critical. Remember, your first version is always your worst version. Most importantly, get the concept right. Make sure what you are doing is correct, because ultimately this will be using real money, and you want to protect your money as much as possible. So worst version or not, if you make money from it, it's acceptable. Can it be improved? Of course. Can this be improved? Of course. But does it matter as long as you make money? Probably not. You are the only one that can make that assessment based upon your risk and the number of trades that you have. If you have a situation where you have 500 trades and it's taking you 5 minutes to scan those trades, then you clearly need a way to optimize that approach. 5 minutes versus 3 to 5 seconds at a worst case situation is a critical improvement that needs to be considered. This is how you use AI properly. Artificial intelligence is not a magic black box. It is a tool, just as the computer is a tool, just as computer programming languages are tools. By focusing on how to utilize artificial intelligence in a meaningful and responsible way, you can gain a clear edge and advantage in the market. Not through smoke and mirrors, but through something that can be tested and replicated over and over consistently. This is where you get your edge. This is where you make your profits. Through testing, through analysis, through repetition of being able to evaluate the data and the market consistently. So as we continue to look at our data, and we continue to look at the market, never underestimate how the human brain thinks. Because by taking the time to really think about how our brains are able to look at the information we have, how our brains are able to see that this is an uptrend or that this is a downtrend, is incredibly important, because the computer cannot make that kind of a decision-making process. Even if you look back and you really go back, this is a hot mess. Here we have down, here we have up, this small down, this is an up, but this whole section is an up. Here we have basic support and resistance. And this looks like a complete mess, because it is. The realization of trading is very simple. Less is more. So as you look at the possibilities of trading, this is important, this is important, this is important. The rest of it doesn't matter. As you look at your relevant issues, try to keep everything as simple as possible, especially as you build your program. The fewer moving parts you have in your program, the better your trades will be, because the less time it will take to actually be able to go through and analyze the actual information it really needs to make a clear and concise evaluation and analysis of your data. Because the one thing you need to be careful of is information overload. The more you go back, the worse it gets. For example, if we go to the weekly chart, this looks like a disaster. Where to even begin to go with this? So at some point, you need to really pay attention to how we look at our data. Because as we look at our trades right here, it's really a very small section of a very large market. And that is the true problem of algorithmic trading. You need to take a lot of information that the brain can make sense of and try to give it to a program. For example, here we have a huge market downturn, a brutal one that really is a series of losses all the way around if you have to be on the wrong side of it. But that's the problem. The wrong side of it is never easy to figure out. Whereas here, the market has been pretty stable and in a flat or stationary state. For my kind of trading, this is really the best kind of market because it's consistent. But if you go back to this section, the market shows an uptrend that allows us to look at a different perspective. How do you analyze all of this information and get it right? That really is a big problem, because now we can see the whole market in roughly 21 years, and you can see just how little information we actually have used to put a lot of money at risk. We are looking at a very small fragment right here. But the reality is, all of this is a history of the market that clearly shows a whole different level of thinking, a whole different practice. And when you look at sections of the market like this, that just look like the sky fell, or even right here, as trading is a numbers game, this looks like a nightmare. And yet we are putting our trust in a program with our real money not to screw it up. Not that easy, in all honesty. It can be done, but you must understand the market. You must clearly take into account exactly what your risks are. You must have a worst case scenario plan, and you must accept that you are going to take losses. Information is a wonderful tool, but at some point, you're going to get too much, and too much is going to be a problem. That really is the problem that AI can help solve in trading, particularly algorithmic trading, where you're depending upon the machine as your proxy. But at the same time, you need to be aware that if you don't give it the right information, it is going to bankrupt you, and you are going to suffer incredible and deep losses. So even if you use AI to help optimize the thinking process and planning of your trades, you cannot I repeat, you cannot take the market for granted or just assume that the machine is going to get it right. You must always stay vigilant in your trading. You must always look at the market, looking for different approaches, techniques, refinements that help keep you profitable. And most importantly, you must always be prepared for the inevitable loss that is going to come sooner or later. Trading is an enjoyable activity. It is fun, and there is nothing that feels better than making money. But it is a gut-wrenching punch to lose it, and it's even worse when you've lost it at the hands of a machine that has gone out of control. Algorithmic trading is wonderful as long as you take the time to practice, learn, refine, test, and analyze everything carefully. If you like this video or this kind of content, please subscribe to my channel. Join my support server. Feel free to let me know what you think about this video or this topic. Thank you for watching.